Greetings from all of us here at Wespath, and thank you for joining us today for our fourth quarter 2023 webinar. My name is Joe Halwax, Managing Director of Institutional Investment Services. The beginning of 2023 was a time of many doom and gloom predictions. The Fed was raising rates, consumers were pessimistic about economic outlooks, many economists were predicting a recession, and Wall Street was calling for a negative year for stock returns. Fast forward 1 year and the outlook is more positive. That is in part thanks due to positive returns and headlines seen throughout the fourth quarter. I will delve into more of this economic news later in the webinar with my colleague Dave Zellner. Lucas Schoeppner from our Sustainable Investment Strategies team will also join me to talk about recent developments regarding methane gas emissions. And Karen Manczko and I will sit down to discuss Wespath Fund performance. We'll also have a very interesting conversation between Frank Holsteen and Johara Farhadieh about the latest trends throughout financial markets. But first, let's dive into what's new and noteworthy here at Wespath. Our most recent blog post summarizes the key takeaways from 2023 and top themes as we begin 2024. Before that, Miles Smith and I wrote a blog about holiday traditions, book recommendations, areas of gratitude, and more. We interviewed a handful of staff members, including myself, so if you're looking for some new content to read or listen to as you kick off the year, I encourage you to check it out. We also have some exciting news from elsewhere in the organization. Wespath successfully raised $250,000 in funding for our Clergy Financial Wellbeing Initiative. This has been matched by a generous $250,000 grant from the Lilly Endowment. In 2022, the initiative received $250,000 from Lilly Endowment and was presented with the challenge to raise an additional $250,000 to unlock matching funds. With the matching funds, the initiative has already begun allocating resources to well-being efforts focused on post-pandemic recovery for clergy of color. This includes programming dedicated to self-care and wellness, all to help clergy mitigate burnout, expanding emergency financial assistance, and providing financial backing for wellness retreats across the United States. We're grateful for the generosity of many of our clients and ministry partners who supported this initiative. We're excited about the impact we hope this initiative will have. If you're interested in learning more, a link to the full press release will be available in the description box. Thank you and enjoy the rest of the webinar.
Welcome. I'm Frank Holsteen, Managing Director of Investment Management at Wespath. I manage the team that oversees our investment funds, and I'm now joined by Johara Farhadieh, our Deputy Chief Investment Officer. We're going to spend the next few minutes talking about markets, how stocks and bonds finished the year in Q4, and what drove them throughout the year. Johara, thanks for being here with us.
I'm so excited to be joining you, Frank. This is really the first of many market updates that we'll be doing together. I'm looking forward to it.
One theme I'm interested in diving into is the concept of narratives. We've got a few movie buffs on the investment team, and I'm not talking about character arcs and plot holes. I'm talking about how many times we saw the prevailing investment narrative shift throughout 2023. Our asset manager partners at JP Morgan said recently that 2023 certainly didn't follow the script most strategists were projecting. We started the year with investors worried about high inflation and a recession. Then we took an unexpected turn in March during the regional banking crisis. By the end of the year, people were talking about the Magnificent Seven stocks, softer inflation, and possibly even interest rate cuts. What do you think explains all of these shifts in narrative?
Well, first, I have to admit, I'm definitely not a movie buff, so I'm glad we're here to talk markets, Frank. While the end of the calendar year is a natural point of reflection, if you zoom in on any year, it's likely you're going to see investors shifting and changing their mind. As you know, it's notoriously hard to nail economic and market forecasts. The beginning of the year is when a lot of predictions do come out. And so in my years as Chief Investment Officer, I've trained myself to filter through what I call the noise, these narratives shifting. Taking the lens of a long-term investor, I take the information that I think is most relevant for our portfolios and investors, focus my attention there, and ensure our strategies are aligned with such views. In the context of 2023's shifting narratives, let's also think about what the world has been through over the past few years. As we've noted many times, our lives were forever changed by the COVID pandemic. More recently, if anything can shift a narrative, we've had several regional wars escalate, beginning with Russia's invasion of Ukraine, then Israel and Hamas, and now with the tension increasing in Yemen around the Red Sea. We can consider the potential of economic impacts of these conflicts, but I also want to recognize the tragic impacts on lives in the communities. So to get back to your question, it could be that we're all trying to understand the long-term impact of all these changes.
Yeah, good point. So the real economy and what goes into economic forecasting have changed. Let's just quickly touch on Q4 equity markets and where things ended for the year. On this slide, we see a lot of double-digit numbers. The S&P 500 gained nearly 12% in the quarter to end over 26% higher for the year. International stocks finished more than 18% higher for the year. And of course, the stocks of those very large mega cap companies soared, ending the year with almost triple-digit gains. What comes to mind when you look at the chart, Johara?
Well, Frank, I see what you see. I see good news for those investors with equity holdings, especially after 2022, which was a really tough year for stocks. As you mentioned earlier, Frank, declining inflation gave hope for potential Fed rate cuts in 2024. Along with third quarter corporate earnings coming in strong, this gave a boost to equities to end the year. Perhaps a surprisingly stronger boost than many had anticipated. But we also know that historically, equities perform well in the fourth quarter. But of course, there's still a lot of question marks. The December inflation data was higher than expected, highlighting that the Fed has likely more to do around inflation, significantly lowering the chances of the first quarter rate cut. We also don't know how much the economic growth will cool this year, if at all. Mm-hmm. But while we hear a lot about soft landings, I also think as investors we need to consider volatility, shifting narratives, so considering a bumpy perhaps or a more choppy landing at times. As recently noted, we're seeing significant layoffs happening in the beginning of the year. I know Citigroup announced the layoff of 20,000 employees. We know BlackRock, Amazon, Spotify. At the same time, I recently read that JP Morgan is looking to add employees this year. Again, and of course, as you point out, there's a focus on the concentration in those mega caps that we've talked about. So there are questions about not only the Magnificent Seven, but also the 490 plus other names in the S&P 500, Frank.
Right, let's talk about that a bit more. We've obviously heard a lot about the Magnificent Seven recently, and our team here at Wespath has been covering it throughout the past year. Our friends at JP Morgan also provided some interesting data on this market concentration. In 2023, the top 10 S&P 500 stocks returned 62%, while the other 490 stocks returned just 8%. And 72% of the S&P 500 stocks underperformed the broader index, which is the second highest percentage since 1980. What do you make of this pretty remarkable trend?
It really is remarkable. As we've talked about recently, there's excitement around tech and artificial intelligence. And perhaps with good reason. AI is really probably going to transform the world. And there will undoubtedly be companies that will profit significantly by leading this transformation. This is probably best evidenced by NVIDIA, which is the strongest performing Magnificent Seven stock with a 239% return last year, Frank. NVIDIA is a computer chip maker that's directly targeting the AI and machine learning industry. Time will tell us exactly which of these companies will profit from the AI transformation, but for now, the Magnificent Seven do demonstrate strong earnings growth. That evokes more confidence and faith in the group of the stocks versus the dot-com era of the past, which was the last time we saw this level of market concentration. Beyond that, there also may be some impact resulting from the popularity of indexing, where investing in market cap weighted indices is inherently tilting people towards these massive companies or mega caps. And finally, maybe we're thinking about this a little wrong. Maybe we shouldn't be focusing solely on the Magnificent Seven, but also considering the 100 of other stocks in the S&P 500. What does the rise of the Magnificent Seven mean for those other companies? Were opportunities created for the rest to rise as well over time?
Well, that's an interesting point, Johara. These Magnificent Seven are great companies with strong earnings potential, but we also need to remember that we've seen this market concentration pendulum swing in the past. So this would tend to reassure more diversified investors with a long-term horizon that there's still an historical benefit to keeping that diversification.
I agree, Frank. Diversification is key in the world that we're in, and the pendulum does swing.
Let's switch gears here a bit and look at fixed income markets. It was a positive year for bonds, which similarly to stocks is a relief after the volatility of 2022. Where should we start with the fixed income landscape?
Well, let's take a look at the yield curve. That's where we always start. On this slide, the orange line is the yield curve at the end of 2023. The blue line is where we started in the quarter, and the green line is where we ended in 2022. One thing stands out to me. The longer end of the curve fell to end the year, leaving us pretty much where we were a year ago. It's basically where the orange and the green line meet, Frank. That's certainly interesting, considering all the narrative shifts and the things we've learned since then. We didn't see a recession. We've had another 100 basis point rate hike. Inflation was about 6% at the end of 2022, and it's now about 4%. So a lot's changed, and yet when you look at the longer-term view on the yield curve, it's very similar. And as we noted earlier, equity markets ended the year strong, along with these fixed income markets.
Right, so let's look at those returns now. Here we see the Bloomberg U.S. aggregate finished the year up 5.5%, while the Bloomberg Global aggregate gained 7.6% last year. Those full year numbers had a lot to do with Q4. Actually, heading into Q4, the U.S. aggregate was on track to post its third consecutive negative year. That would have been an historic first for the index, but as you noted, yield moved lower on the quarter, which helped bond prices surge into the green for 2023.
There really is a story to tell on the bond markets. This is a good time to give kudos to our colleagues. Recognizing that, several members of the Wespath team contributed to a series on fixed income opportunities last quarter. We had Connie discussing the fixed income market as a whole. Peter dove into private credit. Evan looked at the advantages of actively managed funds. Those are all up on our Investment Insights blog, and I encourage viewers to check them out. They're timely reads.
Agreed. Those are excellent resources. Any final thoughts as we wrap up?
Well, how about the Bitcoin ETF?
Yes.
Okay, I'm just kidding, Frank.
Okay.
That's something for us to discuss at a later date.
All right.
My final thought is back to the idea of these narratives shifting. We should avoid being reactionary in the short term. And as you know, so many economists were wrong about the recession. Many Wall Street analysts were wrong about the markets being down. And as fiduciaries, we'll continue in our disciplined long-term approach, building diversified funds that allow for our clients to make choices based on their investment needs. So as you know, the main driver of returns is the client's asset allocation. So filtering out the noise and making long-term strategic decisions should be the focus. And most importantly, the Wespath team, including myself and you as well, Frank, are available to work with our clients to determine the right portfolio for their organization.
Absolutely, Johara, and thanks for joining me.
And thank you, Frank.
I'm joined by my colleague Karen Manczko, who will provide an update on the Wespath fund performance. Karen, thank you for being here.
Thanks, Joe, and greetings, everyone, from a very cold Glenview, Illinois.
In our market update, our colleagues Frank and Johara discussed the continued economic resilience we've experienced and the positivity that stemmed from declining inflation. They zeroed in on some weak points and reasons to be cautious about too much optimism as we start this year. However, there was certainly a lot of encouraging upward trends in the fourth quarter. How did this positively reflect on the Wespath funds?
That's right, Joe. Global equities finished the year strong with an Uber Bowl run in November as investors gained confidence in a soft landing. All equity sectors were up for the quarter, with U.S. equities ending 26% higher for the year and non-U.S. developed equities up 18% on the year.
In bonds, at the end of the third quarter, returns were negative, but it looks like fixed income also ended the year strong as well.
They sure did. November was really an everything rally month. Equities reversed the losses from earlier in the year, and bonds were up as well, finishing the year in the green.
You mentioned that there's growing optimism for a soft landing, which for viewers we would define as an economic slowdown that cools inflation but doesn't cause a recession or sharp sell-off. What are some of the other reasons for these strong returns in stocks and bonds?
As I mentioned, the dovishness of the Fed definitely supported the markets, but we also saw inflation concerns easing as inflation itself appears to be cooling. Inflation peaked mid-2022 at 9.1% and fell to 3.1% in November of 2023. If we think back on 2023, we started the year gearing up for a recession. By the summer, the consensus view was rates higher for longer, and by the end of the year, everything shifted with the cooling inflation and now calling for a soft landing. It's been an emotional roller coaster for us investors, to say the least.
All right, let's turn the topic to the Wespath funds. Can you give us an update on how all this impacted us for the quarter and also for the year?
Of course, but before I dive into that, I do want to explain to some of our investors that we're going to report and showcase our long-term fund performance. And this is going to be our composite performance figures. Our composite reflects both P-Series and I-Series performance combined on an asset-weighted basis. Investors in the I-Series funds will be familiar with these, since we show these composite information to reflect a longer-term history of the strategy. For P-Series investors, I just note that the I-Series funds have substantially similar investment objectives and strategies. Now, let's take a look at the results for the quarter and full year. You can see that the Wespath equity funds ended in positive territory for the quarter and 1 year, with both our U.S. and international equity fund composites up over 10% and 9% and 22% and 12% net of all fees. The U.S. equity index fund composite was also positive for the quarter and year and returned over 12% and 26%. Despite the positive absolute performance from the equity funds, they did underperform their respective benchmarks net of all fees for the quarter and 1 year. For the quarter, the U.S. equity fund composites overweight to small and mid-cap stocks contributed to the performance as we saw small and mid-cap stocks outperform large cap for the quarter. With this said, the fund's underweight to mega cap, specifically Microsoft, Amazon, Nvidia, and Facebook, detracted as these companies returned 14% to 19% for the quarter. Unfortunately, the two equity fund composites allocation to private equity and private real estate detracted as these valuations on these asset classes in both the U.S. and non-U.S. could not keep pace when we see strong public market and these asset classes are lagged. This was the main detractor for the quarter for the international equity fund composite. I'll spend more time talking about the specific contributors and detractors to the year-to-date performance in a moment.
So Karen, you mentioned that the fixed income fund also ended the year higher with a very strong fourth quarter. Can you tell us a little more about the quarter and the 1 year performance for both bond funds?
Yes, fixed income markets performed remarkably well in the fourth quarter as inflation tempered, central banks signaled the end of the tightening cycle, and the economy remains resilient. Therefore, both composites were positive on the quarter and 1 year, which was a great turnaround for this asset class. The fixed income fund composite was up over 6% for the quarter and almost 8% year to date.
So it's great that the fund returned positive numbers for the quarter and year to date. And what were the specific drivers for performance?
This was really a risk-on quarter, not only for equities, but also for fixed income. The composite is primarily actively managed. Therefore, the collective work of our active managers and their issue selection, along with navigating the yield curve and duration in this challenging environment, has really benefited our investors. Also, the meaningful decline in yields pushed bond prices higher, benefiting performance. The composites benefited from the overweight allocations to and selection within high yield and emerging market during the risk-on quarter.
All right, so before we move on, are there any comments about the other bond fund, the Inflation Protection Fund?
Yes, a few quick updates. As I mentioned, the Inflation Protection Fund ended the quarter and year in positive territory and outperformed its benchmark for both time periods. The composites underweight to U.S. Treasury inflation-protected securities and the out-of-benchmark allocation to emerging market inflation-linked bonds helped relative results. The non-dollar exposure also helped as the dollar weakened versus a basket of currencies during the quarter.
Thanks, Karen. So before we talk about specific contributors and detractors for the years, let's get a sense of where we are compared to others in the industry. Can you tell us how the multiple asset fund compared with other balanced funds?
Yes, of course. This next chart showcases the multiple asset fund composite versus a universe of balanced funds. This slide measures how our balanced fund composite performed relative to other balanced portfolio and funds that are currently on the market. Looking at the chart, you can see that the multiple asset fund composite has performed above the median across all time periods, with the exception of the 3-year, which was below, as you can see from the chart. But the 10-year time horizon, the multiple asset fund outperformed 58% of its peers.
Great, thanks, Karen. Now let's think about those contributors and detractors to the fund's year-to-date performance. Can you break down what helped and hurt the fund in 2023?
On a gross of fees basis, the multiple asset fund underperformed by 69 basis points in 2023. No surprise that the positive contributors to the fund's relative performance was the outperformance by our 2 fixed income funds, which comprised 35% of the multiple asset fund. The primary detractor to performance was the equity funds, which I'll talk specifically about here in a moment.
Right, so let's dig into the equity fund's 2023 performance.
Starting with our U.S. equity fund, this fund underperformed its benchmark by over 200 basis points for the year. 5 of the 6 active managers outperformed, which was a contributor to the fund's performance, but the fund's overweight to small and mid-cap stocks and corresponding underweight to mega-cap stocks was the biggest detractor, as we saw these stocks return over 96% for the year. Also, the fund's allocation to private markets detracted. These assets are updated on a 3-month lag, and therefore we have not seen the strong gains posted to this asset class yet for the fourth quarter.
So the mega caps ended the year posting some really strong results, up almost triple digits per year update?
They really did, Joe. These Magnificent Seven, or so they're coined, stocks comprise 28% of the S&P 500. As Frank and Johara mentioned earlier, if you take the S&P 500 and equal weight all of the companies, then the index would have only returned just under 14%.
So it sounds like these 7 names are fairly concentrated in the index.
They are. They make up 2/3 of the S&P 500 returns and have really been dominating the U.S. equity market.
So you also mentioned that the International Equity Fund underperformed its benchmark for the year. What were the drivers of that fund's relative performance?
The International Equity Fund underperformed by 208 basis points. The primary reason for the underperformance was stock selection by our fund's active managers, particularly in utilities and industrials.
So it sounds like active management played a big part in the international fund's underperformance. Are there any other contributors, detractors that you'd like to highlight before we move on?
Yes, the fund's allocation to private markets, similar to the U.S. equity fund, also detracted due to the lag in valuations for this asset class. A positive contributor was the fund's ethical exclusions, particularly not investing in tobacco companies, helped the relative performance of the fund.
So now let's talk about bonds and the 2 fixed income funds and how they performed in 2023.
As I mentioned earlier, the fixed income funds had strong absolute and relative returns. The funds benefited from its overweight allocation to high yield and emerging market debt. 6 out of the 8 strategies outperformed too. The fund's active managers' issue selection also contributed specifically in investment grade credit. The only detractor was the fund's allocation to agency commercial mortgage-backed securities.
All right, so let's move on to the final fund, the Inflation Protection Fund.
The Inflation Protection Fund outperformed by 194 basis points for the year. As I mentioned, risk on assets did well, and therefore the underweight to U.S. TIPS and out-of-benchmark allocation to emerging market inflation-linked bonds helped relative results. The exposure to non-dollar also helped as the dollar weakened versus a basket of currencies for the year. The floating rate leveraged bank loans also contributed. These loans pay a floating rate of interest. Therefore, as short-term rates move higher, so did the coupon payments of bank loans, making them particularly attractive to investors in 2023 and contributing to our fund's relative results.
Thanks for that performance summary, Karen.
Thanks, Joe.
Thanks, Dave, for joining the quarterly webinar. As is our custom, we'll start with the U.S. economy. As we discussed after the third quarter, most of the experts got it wrong about the likelihood of a recession, just like the experts said inflation was transitory and that the U.S. stock market would be lower in 2023. But I digress, back to recession. As we look ahead to 2024 and consider whether or not we may see that long-awaited recession, what's your take on what transpired in 2023?
Well, thanks, Joe, and hello to our viewers. I'm once again pleased to share my thoughts on the U.S. and world economies and markets. And as you said, Joe, The experts clearly missed the mark with their forecasts on many levels. So this first chart shows the average predictions from 70 economists and strategists surveyed at the beginning of 2023 by the Wall Street Journal. These 70 experts represent a diverse set of institutions, including Wall Street, academia, think tanks, and nonprofits. They collectively believe that the U.S. economy would grow a meager 0.2% for the year and assigned a 60% probability of a recession in 2023. However, if the Atlanta Fed is correct that inflation-adjusted growth in the fourth quarter was 2.2%, then the economy would have grown at 2.8% for the year. That would be right at the average for the last 50 years, which is quite remarkable given that population has steadily declined over the last 50 years.
So let's pause here a second, Dave. What do you think that the main reason was that the U.S. economic growth defied predictions, and where did all the market forecasters get it wrong?
Good questions, Joe. Last year, the experts felt that high mortgage rates and lackluster manufacturing activity would negatively affect the housing market, which is often a growth engine, and that layoffs in the manufacturing sector would put a dent in consumer spending. And as we've discussed in the past, consumers account for 70% of the U.S. economy. Now, according to the Bureau of Economic Analysis, which is a division of the U.S. Department of Commerce, the increase in consumer spending reflected increases in the purchase of both goods and services. Within goods, the leading contributors to the increase were recreational goods and vehicles, as well as other non-durable goods led by pharmaceutical products. Within services, the leading contributors were housing and utilities, food services and accommodations, and healthcare.
So then why do you think we didn't see a dramatic slowdown with 5.25% of rate hikes in 18 months, including the Fed selling a large holding of its securities? And wasn't there expectations that elevated levels of consumer spending were unsustainable, given that many headwinds consumers faced, including a depletion of COVID savings, an end to government stimulus, and expected resumptions of student loan payments?
Now, that's a two-parter, Joe. So first, regarding the dramatic increase in rates, those with a mortgage took advantage of low rates to refinance. And corporations also borrowed boatloads of money at low rates, with a significant amount of that debt not coming due until 2030. This debt restructuring made the broad economy less sensitive to the sharp rate hikes that wasn't immediately felt. As for consumer spending, according to the Conference Board, a global business-oriented think tank, consumers continue to fund spending with their dwindling pandemic savings, increasing levels of household debt. The Conference Board also cited the growth in these buy now, pay later plans. In fact, I've noticed my bank offers to split debit card purchases into 4 equal payments spread 2 weeks apart. And this practice has likely encouraged more consumer spending.
So thanks, Dave. Circling back to 2023 economic forecast, did the experts get anything right?
Well, they were reasonably close on their inflation forecast, predicting that the consumer price index would rise 3.1% for the year versus actual inflation that came in at 3.4%. But they were way off on the unemployment rate, predicting a final rate of 4.7 compared to December's 3.7% rate. Of course, we might expect a lower jobless rate, given that we avoided a recession last year. So forecasts for lower rates for both the bellwether 10-year U.S. Treasury and the Federal Reserve's overnight lending rate were both off the mark, again, because of unexpected strength in the U.S. economy.
So now that 2023 is behind us, let's look ahead to 2024 and both the outlook for growth and inflation. We're both fans of Dr. David Kelly, who's the chief global strategist for JP Morgan. He's known for the Guide to the Markets, which is often a source of charts we use with clients. In his first webinar of 2024, he offered predictions using each digit in the year 2024. He felt that the U.S. economy would grow 2%, it would experience 0 recessions, inflation would end the year at 2%, and unemployment will remain at 4%. Do you agree with Dr. David Kelly's forecast, Dave?
So while I do have a lot of respect for David Kelly, I think he may be a bit optimistic. And I should note that his boss, Jamie Dimon, warned in JP Morgan's most recent earnings call that he thought inflation would be stickier and that rates could be higher than investors expect. Dimon also opined that the expected soft landing is at risk as growth is being fueled by these large amounts of government stimulus spending and other past stimulus. But let's look at what the experts are now saying. In terms of GDP, the economists expect 1% growth for 2024. They collectively also pegged the probability of recession at 39%.
So then why are you more closely aligned with the Wall Street Journal's panel forecasts of just 1% growth?
So for the aforementioned reasons, curtailment of government stimulus, depletion of savings, resumption of student loan payments, and bills coming due. While I do worry a bit about the potential for a recession, I do agree that rates will likely fall throughout the year. Falling rates are positive, especially for the dormant housing market, as well as for strengthening business investment. In addition, business conditions continue to deteriorate. On this next slide, the left chart shows the path of the Conference Board's leading economic index. It shows the current conditions are approaching a level last seen at the onset of the pandemic. The right chart shows that small business owners continue to communicate level of optimism regarding future economic trends. The economy is facing some headwinds that may be difficult to overcome. Now, of course, these are near-term concerns. However, we at Wespath maintain our optimistic outlook for moderate but sustainable economic growth for the longer term.
So Dave, what about inflation? Do you think that we're going to reach the Fed's 2% target by the end of the year? And I'll note that the latest reading ticked higher to 3.4%, with core coming in at 3.9%.
We're clearly headed in the right direction, Joe. In the past, I've talked about the extent to which housing costs have been significantly responsible for keeping overall inflation rates higher. This next chart shows the recent path of inflation for the three largest components of the Consumer Price Index. Shelter costs have continued their steady decline from their 8.2% peak. That said, I wanted to show this next chart from Realtor.com. Viewers should focus on the black line on the left y-axis, which represents the annual percentage increase in rents for two-bedroom apartments. While we saw a huge spike in rents on the heels of the pandemic, annual rental rates have been declining over the past 8 months or so. What's more, a substantial number of completed housing projects will hit the market this year, placing further pressure on rents. Hence, we should continue to see decline in shelter costs, which increases the chances of reaching the Fed's 2% target sooner rather than later.
And what about employment, Dave? Do you align more with Dr. Kelly's predictions that the rate will remain below 4%, or do you think the consensus forecast of 4.3 will be more realistic?
So, given my reservations that the economy will grow at 2%, then it seems that the unemployment rate will likely rise. I clipped headlines on this next chart from news reports that came out just over the last couple of weeks. And while it's true that layoff announcements occur more often in January than any other month, any scaling back in consumer spending will likely result in accelerated job cutbacks.
So before we move on to talk about international conditions, is there anything else you'd like to cover regarding the U.S.?
Sure, Joe. While my near-term outlook may not be very rosy, conditions for corporate profitability continue to improve. Earnings growth in the third quarter of 7.5% far exceeded analyst expectations, as we can see in the chart on the left-hand side. On the right side, we see that while analysts expect earnings to grow at a lower rate in the fourth quarter, forecasts for 2024 and beyond are quite optimistic. And that's a reassuring sign as we head further into the new year.
Great, thanks for that, Dave. Let's now talk about international. So investor interest in the long dormant Japanese economy and its stock market seem to have been revived. It's been quite some time since investors have had positive things to say about investing in Japan. So what can you tell us about the world's third largest economies and the reasons why it's now drawing more investor interest?
So I agree, Joe. There's been a lot of chatter recently about Japan. In past webinars, we've talked about Europe, the UK, the emerging markets, and especially China. But I cannot recall a conversation that you and I have had about Japan. So it's good time for us to catch up on the news there.
So how has the Japanese stock market performed as of late?
So the Nikkei 225 stock index gained 28% last year, slightly exceeding the S&P 500's 26% return, though that 28% gain was in Japanese yen, which depreciated about 7% relative to the US dollar. So on a dollar basis, the S&P 500 did better. Now, from what I've read, there are two main reasons why investors have turned bullish on Japan. First, the Tokyo Stock Exchange recently launched policy initiatives promoting better corporate governance with a focus on optimizing how companies finance their business operations. In addition, regulators have placed greater scrutiny on potential conflicts of interests between companies and their independent subsidiaries. A second reason is a return of inflation to the Japanese economy. When an economy is experiencing deflation, consumers defer spending in anticipation of lower prices. In addition, Japan's negative interest rate policy discourage investment or even depositing cash in banks. The return of inflation changes this dynamic. So this next chart, Joe, shows two periods of strong performance of the Japanese stock market. The chart on the left shows the performance during the 1980s when the market skyrocketed. The right chart shows performance over the past 10 years. Certainly, it's not as dramatic as the climb in the 80s, but it is a steady climb. Now, alert observers may notice that even after the Nikkei's rise over the last 10 years, it hasn't yet reached its 1989 lofty level. And indeed, if we look at the entire history since 1980, we can see that someone who invested in the Japanese market back in 1989 remains underwater. It's been over 30 years since that peak, so many investors may consider those to be lost decades for the Japanese market.
So that last chart, Dave, explains why investors have pretty much ignored Japan until recently. Do you have any thoughts on how much longer this Japanese renaissance may last?
Yeah, Joe, I really haven't a clue. The Japanese economy is unique relative to other world economies. It is one of the most rapidly aging societies in the world and must rely on immigration if it wants to grow its economy. Whether its society will be more welcoming to immigrants and whether it continues to make meaningful governance changes remains to be seen. So I have one more slide, Joe, that I put together based on a comment you had made recently at one of our team meetings. At the end of 1989, 6 of the 10 largest companies on a market capitalization basis were Japanese companies. So, Joe, if we were to rank today all the world's stocks by market value, where do you think the highest Japanese company would rank today?
Yeah, we've talked about this as a team. Toyota's the biggest company, but I don't know where it would rank.
Great guess, Joe. It is Toyota, and it's 50th place, with 42 U.S. companies having a higher market value than Toyota.
So that's quite a difference relative to, say, 35 years ago. So before we wrap up, is there anything else you want to mention to our viewers?
Yeah, one last item, Joe, and it's somewhat related to the rise and fall of the Japanese companies we just discussed. Earlier, Frank and Johara talked about the Magnificent Seven and market concentration. This next slide shows the 2023 total return for those 7 stocks and the extent to which the top 10 stocks comprise the S&P 500, which at 32% is now at a historically high level. And this next chart is another one that you posted on our Teams channel recently, which I thought put into perspective just how large of a valuation these 7 companies carry. The market value of all 7 companies exceeds the total value of the companies from Japan, China, France, and the United Kingdom combined.
So agreed, Dave. Although I've also posted an interesting analysis from the Man Group that makes the case why the valuations for these companies may not be that unrealistic, but we'll need to save that debate for another day.
I look forward to that debate, Joe.
So Dave, thank you, and thanks to our viewers. If you have any questions about what you heard today or any others, please do send them along. Here with me now is my colleague, Lucas Schoeppner, who helps manage our investment, stewardship, and engagement activities. Lucas, how are you doing today?
I'm doing well. Thanks for having me, Joe.
So Lucas, it's the start of the year, which means for many people it's a time for resolutions and renewed energy towards long-term goals. I know I have to show up to my college reunion at my college weight, so that means no sugar or bad foods for the next 2 months. But many people have resolutions surrounding sustainability, like meatless Mondays, or maybe their own composting journey. So while all these are great things to integrate into our personal lives, we talk here a lot about Wespath, or at Wespath, about the organizational impact regarding sustainability. So related to this, one area I wanted to zero in on today is methane. As someone who works in centers around sustainability, what can you tell us about methane, and why is it important in our element of stewardship work here at Wespath?
Sure. And your own resolution helped prompt me to at least try to get the college reunion started, so baby steps. So I'll tell you about it. To answer simply, there are several main types of greenhouse gases, such as carbon dioxide and nitrous oxide. And methane is one of these. And while it naturally occurs in small quantities in the atmosphere, excess methane can have a massive impact on the environment because of how potent it is. Depending on the time frame, methane can be 27 to even 100 times worse for the atmosphere than carbon dioxide when it comes to trapping heat. So you're definitely correct that when you touched on the impact of individuals versus large corporations, in a similar vein, one of the best bang for the buck areas where we can make progress on greenhouse gas emissions today is with methane.
So that's a remarkable figure and an important note about why we would want to focus on methane. Can you tell us a bit about the source of this issue? Where do methane emissions actually come from?
Sure. So let's go back to that slide. Some of the main sources of methane emissions are from the energy sector, as well as from agriculture, where emissions come from things like cattle and rice production. On the oil and gas side, emissions can come from a few areas. That includes things like the deliberate venting of methane during the drilling of a well, releases that occur on purpose as part of controllers and switches in the pipeline or wellhead infrastructure, and unintended leaks and major emissions events known as super emitters. The fortunate thing, though, is that we've already got the technology to stop a lot of this methane pollution. We see this focus on reducing methane emissions from the oil and gas sector as one of the best areas for us to focus on when it comes to engagement on climate change. Now, we know the world is going to continue to rely on oil and gas as we move through the energy transition. But there's an immediate climate benefit to reducing methane emissions, making oil and gas production cleaner. And there's an immediate business impact too, whereby companies reduce their waste of a valuable product.
So what kind of engagement work with companies has Wespath been doing when it comes to methane?
Sure. Well, this is one area where we've seen quite a bit of progress amongst U.S. oil and gas companies in recent years. Wespath has conducted site visits at natural gas companies like EQT to review how they're upgrading their infrastructure to reduce leaks at well pads. Some of these companies are also doing things like switching to electronic valves, which reduce deliberately vented methane. As I mentioned, the return on investment for these upgrades is often quite attractive. After all, the less natural gas you leak, the more you can sell. We've also been engaging with some big names in oil, like Chevron, ExxonMobil, and Occidental Petroleum, to ensure that they're reducing their emissions too. We encourage Chevron and Occidental Petroleum to evaluate that global shift to a low-carbon future, and after multi-year engagements, both published their first ever climate risk reports. Chevron also created emissions reductions targets and linked those targets to its executive bonus structure, and published a standalone report on their methane emissions this past year. We were actually just in a meeting with Chevron this morning where they were talking about some of the pros and cons of when you're going out to that pipeline or wellhead, judging whether you spend the money on monitoring for leaks that might be there or just spending the money on making those upgrades right away that could stop the leaks that might be there. So a lot of interesting trade-offs that are taking place with these companies and the work they're doing on
Absolutely.
methane. An important global standard for measuring and reducing methane emissions is called the Oil and Gas Methane Partnership. We've seen lots of progress recently with U.S. companies like ConocoPhillips, just at the end of that last year, and ExxonMobil joining this initiative. We're hoping that Chevron and others are going to follow soon.
So Lucas, where else are you seeing momentum on this issue, and what other engagement levers is Wespath using to encourage methane reduction?
Sure. So interestingly, on the policy side, that's one place where we've seen a lot of movement lately. The regulatory body that is responsible for pipelines in the United States hasn't substantially changed its rules on methane leaks and monitoring in years, unlike the rules in place for oil and gas wellheads themselves. But thanks to insights from some of our partner NGOs, like the Environmental Defense Fund and FAIR, we were able to provide input on what we see as a really strong proposed rule from this agency in the past few months. Wespath actually publicly submitted a comment letter to this agency in support of these new rules on methane leaks. And this is the most significant modernization of these rules around natural gas pipeline leaks in decades. It's the first big update in that policy, despite 15 years of really big oil and gas growth in the US since the fracking boom started. It's also going to help prevent accidents like the Big Cowboy pipeline leak in 2021, which released 5,000 cars worth of annual emissions in just an hour. That was one of those super emitter events that I mentioned earlier. There's also been some interesting policy developments here, too, that came around the recent COP28 climate summit, with the UK setting new standards around methane for gas that it imports, and a joint agreement between China and the US on reducing methane. And all this complements the other systemic engagement work we're doing through the Net Zero Asset Owner Alliance. We've got a few examples of the thought leadership that we're contributing to through the Alliance up here on this slide. This work is really aligned with the policy engagement that we've talked about.
So Lucas, well, I imagine we still have a lot of work to do. It sounds like there's been a lot of progress, which I'm sure is encouraging. I think it's great to see momentum on issues like this where there's been such a clear connection to both long-term sustainability, but also the short-term business imperatives. Is there any final thoughts before we wrap up today?
Sure. It's just like you're saying. It's those clear connections. Reducing methane is one of those low-hanging fruits where we've got the technological advancements to implement solutions right now. And because methane is such an important and potent greenhouse gas, extracting and shipping it more responsibly is one of the best steps we can take that could have a meaningful impact on our climate in the near term. It's also a great example of where, even in a politically divided environment, long-term investors and smart engineers and oil and gas field workers can come together to implement practical solutions in a win-win way.
Great. Thanks for that wonderful update, Lucas.
Thank you, Joe.